Welcome to Factful Finance. What if I told you the decisions made by policymakers in Washington, D.C. could send ripples across global financial markets, affecting everything from your retirement savings to the cost of groceries? It's true. The impact of U.S. monetary policy extends far beyond America's borders, influencing economies, investments, and markets worldwide. Today, we're diving into how exactly the Federal Reserve's actions shape global financial landscapes. Buckle up, this one's going to be an eye-opener. Before we dive in, a quick reminder. This content is for educational purposes only. Always consult a certified financial professional for personalized guidance. Now let's get into it. The U.S. Federal Reserve, or Fed, has a profound role in shaping not just the American economy, but global financial stability. Through tools like interest rates, open market operations, and quantitative easing, the Fed influences the cost of borrowing, consumer spending, and inflation. Not just in the US, but all over the world. Picture this. You're in Europe, looking at an investment in the US stock market. If the Fed raises interest rates to cool down inflation, borrowing costs rise. Investors might shift their focus to assets in other parts of the world, causing the US dollar to strengthen, and global stock markets to feel the heat. That shift can create ripple effects, affecting everything from the price of oil to the ability of emerging markets to secure financing. It's like a game of financial dominoes. Take the 2013 taper tantrum as an example. When the Fed signaled it would reduce its bond buying program, global financial markets reacted sharply, with bond yields surging and emerging markets facing capital outflows. Investors were suddenly nervous about higher US interest rates, which would increase the cost of borrowing globally. These shifts illustrate just how interconnected the world's financial systems are. The Fed's monetary policies also impact inflationary trends worldwide. Think of inflation as a global juggernaut. When the Fed raises interest rates to control inflation, that usually leads to a stronger US dollar. A stronger dollar means US imports become cheaper. But for countries relying on exports to the US, it could squeeze their profits. As a result, their economies might feel the pinch, causing central banks in other countries to adjust their own monetary policies to stay competitive. Real-world impact? Let's talk about Emma, a small business owner in Brazil who sources materials from the US. Every time the Fed hikes interest rates, the value of the US dollar climbs, making her costs higher. To stay competitive, Emma has to raise her prices, something that could hurt her bottom line in the long run. And it's not just emerging markets that feel the heat. Even the Eurozone and Japan adjust their monetary policies in response to US actions. Central banks in these regions might lower interest rates or engage in their own forms of quantitative easing to keep their currencies from rising too much against the dollar. These actions, in turn, affect global trade and investment flows, creating a constantly evolving financial ecosystem. The global financial markets are a complex web of interconnections, and the Fed's decisions are at the heart of it. This interconnectedness is why central banks across the world closely monitor the U.S. Federal Reserve's actions and adjust their strategies accordingly. The question now is, how can you, as an investor or a global citizen, stay ahead of these fluctuations? Understanding U.S. monetary policy is a crucial step in managing financial risk and making informed decisions. By staying updated on the Fed's moves and global reactions, you can better anticipate market shifts and fine-tune your investment strategy. So, which of these insights stands out most to you? Drop your thoughts in the comments. I'd love to hear what's on your mind. If this deep dive gave you a fresh perspective, you won't want to miss the next one. Click the video on screen for more eye-opening financial insights. And remember, this content is for educational purposes only. Always consult a certified financial professional before making any major financial decisions. Let's keep learning and growing our financial IQ together.